Hi everyone, welcome to CINFO. In this video, I will help you understand what term life insurance is. So what is a term life insurance? This type of insurance is similar to your home or car insurance, where you pay an insurance premium every month or year, and if the insured person did not pass away that year, you end up losing the premium you paid for the entire year. But on the other hand, if the insured person passes away, your family will be paid the promised amount. So with this type of insurance, you really do not own the policy. What I mean by this is there is no cash value. The policy only pays a benefit if the insured person passes away. Else you lose all the premium paid. And it's for a fixed term, usually 10, 20 or 30 years. And this is the most cheapest type of insurance that you can get. So with this insurance, you are buying protection for your family at a very minimal cost. Okay. Now let's discuss the major types of term life insurance policies. There are two types. One is called a level term and the other one is called annual renewable term. Let's see an example to understand both of these. Let's start with the level term. In this type of policy, the premiums remain the same throughout the life of the policy. As long as you keep paying the monthly premiums, your policy remains active. If you stop the payments, the policy will become inactive. Here's an example. Let's say a person named Alex of age 35 wants to get a level term policy with the death benefit of $500,000 for a term of 20 years to protect his wife and children. So he applies for an insurance policy. If the insurance company approves the policy request, it will come up with a contract that will state the monthly premium that Alex has to pay for the requested benefit. So as you see in this picture, the person being insured is Alex here. The beneficiary are Alex's wife and children. The death benefit on the policy is $500,000 and the policy term is 20 years. Finally, there is the insurance premium of $26 that the insurance company is asking Alex to pay every month until the life of the policy. That would be for the next 20 years. So now, after Alex gets this policy, there are two possible outcomes. The first possibility: if Alex dies within the next 20 years while the policy is in active status, that is, premiums are paid properly, then the insurance company will pay $500,000 to the beneficiary, which is Alex's family here. The other possibility is if Alex is alive for the next 20 years, Alex loses all the premium paid for the 20 years and his coverage ends. So Alex would lose about like $6,240 in total, assuming Alex paid $26 per month for 20 years. So you have to clearly understand that the money Alex pays is just to buy protection for his family from an unfortunate event, which no one wants to happen. So what he bought was just peace of mind and the financial protection for his family for a period of 20 years. Okay. Now let's move on to annual renewable term policy. I will again explain this with an example. Let's say there is a person named Alex of age 45 with wife and two kids aged 4 and 6. Let's say Alex is expecting to get a lump sum amount of $1 million from his previous business dealing. But it will take 2 to 4 years for him to receive this money. Once he gets the money, he plans to save the $1 million for the protection of his family. So right now, he has a temporary need to get a life insurance to protect his family during the next 2 to 4 years until he gets this $1 million. He is not very sure if he would need the protection for exactly 2 years or 3 or 4. So in this scenario, one of the best option for Alex would be to get an annual renewable term policy. Okay, let's say Alex applies for annual renewable term policy with a death benefit of $500,000. If the insurance company approves the policy request, it will come up with a contract that will state the monthly premium for the first year that Alex has to pay for the requested benefit. Then on year 2, if he needs the policy to remain active, Alex has to renew the policy. During the renewal, the insurance company will come up with a new premium amount that Alex has to pay for year 2. So as you see here, this is the contract. The person being insured here is Alex. The beneficiary are Alex's wife and children. The death benefit on the policy is $500,000 and the policy term is only 1 year, but it can be renewed every year until age 95. Finally, there is the insurance premium of $26 that the insurance company is asking Alex to pay every month for the first year. And this premium will go up every year if Alex wants to renew the policy. So let's assume Alex got this policy and is paying his monthly premiums. Now let's discuss some possible outcomes. The first possibility: if Alex dies while the policy in active status, premiums are properly paid, then the insurance company will pay $500,000 to the beneficiary, which is Alex's family. Let's look at another possibility here. Let's say Alex gets his $1 million in year 2. Now he can stop paying the premium and get his policy cancelled. Alex just ended up paying about like $312 for year 1. So this policy helped Alex buy protection for his family in an inexpensive way. Now let's look at another possibility. Let's say Alex does not get his $1 million even after year 4. He can go ahead and keep the policy active for year 5 by just renewing it. So as you see in this example, you need to go for an annual renewable term policy only if you have a short-term need and if you're not sure about the number of years you would need the coverage for. But let's say you know for sure that you need the protection for the next 5 years. Then in that case, a regular term policy would be cheaper than an annual renewable term policy. That's all I had on term life insurance. Hope this video was helpful. Thank you.